Okay, we're going to look at speculating and using the futures markets to speculate. The point of this example is to show you the difference between really the advantages of using the futures market to speculate. So um, let's just go through this example here. So I've got an example here where you're an American investor, you deal in US dollars, but you're convinced that the British pound is going to appreciate a lot relative to the US dollar in the future, meaning you're convinced that the British pound will buy more dollars in the future than it does now. Okay? So you're willing to take a position up to 250,000 pounds. And the current exchange rate is that much per pound. And the example set up here to show you the difference between speculating with the dollars and speculating with futures markets. So the first case is the spot market, meaning you just go out and buy the pounds today, and then in the future you're going to use them to buy dollars, which you think they'll buy a lot more dollars in the future. Okay, so you're going to buy those today. How many dollars will you need? Well, you got 250,000 pounds that you're willing to speculate in. Each pound costs 1.5470. So you need to invest $386,750 today. Right, that's how much you would have to spend in dollars today to buy those pounds. Right, and then what is your profit if the exchange rate in 2 months is, and I realize some of you might be saying, well, don't you invest these pounds and earn some interest on them? Well, we're just kind of glossing over that detail just to not confuse the problem. So just assume interest rates are zero. All right, this was a few years ago when interest rates were still really low and they were effectively zero. So we didn't earn any interest on those pounds, but 2 months later we're going to exchange them and buy dollars. And I'm asking here, what's your profit if the exchange rate in 2 months is, well, this is $1.6 per pound or $1.5 per pound. Right, and I've got the calculations here. You've got 250 pounds, right? If each pound will buy $1.6, you've made a profit, right? The exchange rate, the pound buys more dollars now than it did before. So you've made a profit, and you can calculate how many dollars that would buy, and then subtract off the amount you put in to start with, and that's 13,250. Okay? And if it goes the wrong way on you, the pound buys less dollars than it did in the future. Well, it's the same calculations here, just the exchange rates move down. And so you would lose $11,750. All right, so that's speculating in the spot market. The point this brings up, though, is that you need an awful lot of dollars to get started here. Right, to do it this way, you need an awful lot of dollars, and your profits really are not that high unless you see enormous moves. So this would be a tough way to speculate, even if you were really convinced that the exchange rate was going to move in your favor here. It would have to move a long way to really make a lot of profit here relative to the cost that it takes you to get started. Okay, now a better way would be to speculate in the futures market. So they have these futures contracts, and all you have to do to start this is put up the margin requirement on the contract. So it allows you to take the same gamble with a lot less of your money in at the beginning. Okay, so I've got here the futures price for 2-month delivery is that amount. So just supposing that's what it is. Each contract is for 62,500 pounds, so you need 4 contracts to cover 250,000 pounds. So I'm going to enter into 4 contracts. The margin requirement is $5,000 per contract. Right now, this again is a detail. Contracts are usually a percent of the value. The example just gives you the cost of the margin just to make it easier. So you got to put in $5,000 per contract. All right, so obviously you're going to need $20,000, but notice it's a lot less than you needed if you were just going to buy the pounds today and hold on to them. So, okay, a whole lot less. So $20,000 you need to start this futures position. Okay. Now, do you want to take a long or short position? And this is kind of a tricky question. It's you have to kind of think through it. I don't know a a nice rule of thumb to tell you how to pick this. You just have to think it. And remember, you're expecting the pound to buy more dollars in the future, so that you're expecting the price to go up, right? The price of these pounds to go up relative to dollars, right? And the way to profit when the price goes up is to take a long position, right? Because the long position says, well, I'm going to buy at this price. And if the price goes up, it's as if you bought at that price and then sold at the higher price after the price went up, right? So since you want to profit from the price moving up, you're taking a long position here. Okay. And then what is your profit if the exchange rate in 2 months is, well, the same thing, $1.60 or $1.50. And now I've got here the futures price for delivery in 2 months. Oh, okay. And then I've got here the exchange rate in 2 months. Technically, to be correct, this should say, what is your profit if the futures price on this contract in 2 months is this, right? So when you want to close this out, you've taken a futures position, and the price that you're going to close it out at is going to be the price on that futures contract that expires when you for the contract you're at. Okay? So assume that that is 1.6 or 1.5. All right, and then the way to do this is with the futures contract. Remember, we took a long position, so that means we have agreed to buy at this. And so the way to figure it out is, well, if we're closing it out and the price on the futures contract now is this, it's as if we buy at that price and sell at this price. Sorry, sell at the price now. So we buy at the original price, where we took the contract out to start with, and we sell at where the futures price is now. Right? If we were short, it would just be the opposite. We would be selling at this price and having to buy at this price now. Right? But we're long, so we're going to buy. It is as if, okay, we were buying at this price and getting to sell where it is now. Okay, and in this case, that gives us a profit of 14,750 if it goes to 1.6. And if it goes down, that gives us a loss of 10,250. Okay, and I know these numbers look very similar to the previous profits, but remember, we had to put in a lot less money to get there. Well, we had to put in $20,000, so it's a lot nicer to put in $20,000 and make 14,750. That's a really nice return on your money versus our previous thing. We put in $386,000 and made $13,000. Right? So because it's so much cheaper to start these positions with the futures contract, then they offer a lot more potential to gain. Now also remember, they offer a lot more to lose. So in this case where we lost 10,000, so we've lost more than half of our money. All right, we put in 20,000 to start, and we ended up with only just over 10,000. So a little less than half of our money. No, I'm sorry, we lost a little more than half of our money. We ended up with less than half of the money we put in. And you can see in the previous example, well, here we took a loss of just over, well, almost $12,000, but we put in 386. So as a percentage of our money invested, this is a pretty small percent. Whereas in this case, as a percent of the money invested, this is a huge loss, but it's also a huge gain. So that's how these contracts work. The point is that for a much smaller amount of money, you can still control the same amount of pounds, and you don't have to put in as much money up front. So that's why it's very often cheaper and easier to speculate in these futures markets than it is to take a position in the actual asset that you're interested in. Okay, so that's that. That's a good example there. I'm going to leave it there.